student, welcome to lecture Bookkeeping, the Basics of Financial Information, ICB. My name is Mr. Kwenge. You can contact me on 081 4699 338. Let's look at activity number 1, which will be found on page 19, activity 1F. You were supposed to indicate the effects on the balance, on the owner's equity and liabilities and assets. Let's look at day 1. Your assets has a total of 40,000 coming from your owner's equity of 10,000 and your liabilities of 30,000. Meaning your owner's equity was affected with $10,000 and your liabilities with $30,000. Because your owner did take a personal loan of 10,000 and a loan from the bank of 30,000, which is your liabilities, and which amount of 30,000 has to be paid back. Let's look at activity number 2. Your assets increased by 2,000 and they also decreased by 2,000. No effect has been made on your owner's equity and your liabilities simply because a check was cashed for 2,000, which was supposed to be petty cash. Both of these transactions are affecting your assets only. The petty cash is an asset and your bank was reduced with 2,000. Day number 7, 11,000 increase on your assets and 11,000 decrease on your assets, simply because 11,000 was used to purchase inventory and 11,000 was also used by the company to purchase. So the fact that you used your company money, your bank decreased with 11,000, but then your inventory increased with 11,000, which is an asset. Day 21, you will see your liabilities increased with 12,000 and your assets also increased with 12,000 because office furniture equipment was purchased by credit, on credit. So we need to still pay. We have a liability now of 12,000 because we need to pay back the creditor, and our assets are increasing because we have new office furniture. Day 31, your assets decrease with 3,000 and your liabilities decrease with 3,000 simply because we paid off our liabilities. That's why they are decreased, and we used cash from the business to pay off the asset, to pay the liabilities. So your assets will also decrease. That was the end of activity number 1. It's very important at this stage that I mention that you know the difference between assets, owner's equity, liabilities, and how your owner's equity is affected. Also try and jot down a few examples or what you think assets are, liabilities are, owner's equities are, and always exercise through those and taking into account your books, your examples in the book. Just the final word. When only assets and or liabilities are involved in a transaction, there will be no effect on owner's equity. This statement is true because when you look at your owner's equity, there were no effects on your owner's equity because most of the transactions that happened from the second day to the 31st day were only affecting your assets and liabilities. That's why they did not affect your owner's equity, except from the bank, from the personal loan of 10,000 that you had in the beginning of the month. In this example, none of the transactions had an effect on your owner's equity. If a business buys an asset, takes out a loan, or pays off a loan, it does not alter the owner's wealth. Activity number 2, page 35, number 2.1. were required to distinguish or differentiate between the GST system and the SA revenue systems in terms of which one is better and which one is not, it's more favorable than the other. Let's look at the explanation for the question. The VAT system has indeed been much more beneficial to the SA revenue services than the GST system. The main reason for this is that the VAT system has numerous collection points, making it much harder to commit VAT fraud than GST system, which has only one collection point at the retailer. The reasons for this is that the recipient of an original tax invoice might get audited by SARS, and doing such an audit, cross-checking can be done. If one VAT vendor has claimed VAT input on a purchase, SARS could check whether the supplier has declared the VAT output for the same transaction. You need to understand that VAT input refers to purchases. Purchases that you made, you will be charged a percentage for VAT. That's what they say, VAT input on a purchase is what they refer to. VAT output for the same transaction, by auditing one vendor, another can indirectly be audited since each document has an original and a duplicate version. There is definitely some truth in this rumor. Let's say a supplier bought a product for $50 and sold the same product for $100. If there happened to be no VAT in the system, the profit earned for the supplier would have been $50. Now let's assume VAT is introduced at 14%. The invoice received by this vendor for his supplier, will this be 57? The 57 is derived from adding the 14% VAT on the $50, of which he could claim back $7. It will be human nature for this vendor to add 14% to his selling price, effectively passing the additional tax on to the next vendor in line. On one invoice issued for $114, 14 will be due to SARS as VAT output, effectively leaving income earned on 100. Once again, your 14% is what you charge on the $100. If you say 14% times 100, you will get $14. 100 plus $14 gives you $114. That's the total that you are gonna pay when you do a purchase. But this amount, the $14, can be claimed back when you do your VAT returns. In this way, the profit earned is still $50, but the tax cost has been passed on to the supplier in line. The manufacturer passes the tax on to the wholesaler passes it on to the retailer, and the retailer passes it on to the customer. The unfortunate fact is that many final customers are not registered for VAT, especially the men on the street. So there is nobody the customer can pass the tax on to. Therefore, the final customer often bears the burden of sales tax, meaning that since the customer is not registered for VAT, he cannot claim back the VAT input. Activity number 3. On page 47 in your textbook, exercise 2B. You are required once again to calculate the VAT exclusive amount, the VAT amount, and the VAT inclusive amount. Before we start with this exercise, I want to stress out the importance for you to know exactly the difference between your VAT exclusive amount, your VAT amount, and your VAT inclusive amount. Your VAT exclusive price is the amount before any VAT is charged. For example, if the good costs $100, your VAT is 14%, the rate of the VAT is 14%. Your amount for the VAT is the 14% times your VAT exclusive amount. Your VAT inclusive amount is the total of your VAT exclusive amount plus your VAT amount. Let's look at the first one. Your VAT exclusive price was $439.45. Your VAT amount was $61.52. How did they get the 61.52. They say the 14% VAT rate times your VAT exclusive amount, so which means 14% times 439.45 will give you 61.52, which is the VAT amount. Your VAT inclusive amount is the total of your VAT exclusive price plus your VAT amount, meaning it's the 439.45 plus your 61.52 equals to your VAT inclusive amount of 500.97. That's how you calculate all of these. Sometimes you will be given only the VAT inclusive amount and then you need to calculate the VAT exclusive amount. If you were only given the VAT inclusive amount, example 500.92, you will say 500 to get your VAT exclusive amount. You will calculate saying 500.97 divided times, let me just write down. If you were only given the VAT inclusive amount of $597, to get your VAT inclusive amount, you will say 500 times, the calculation for this is, you will say the 500 times 1 divided by 1.14. Then you will get your VAT inclusive amount. Of 439.45. So this is your formula that you use if you are given the VAT inclusive amount and you need to calculate the VAT exclusive amount. Exclusive amount of 439. To get the VAT amount only you will say the 500.97 less your 439.45 gives you 61.52. That is your effective VAT amount at 14%. That's how you calculate all of these figures. This is the end of the slides and the tutor. Good luck with your exams.